difference between succeeding and failing in Dubai real estate market isn't luck, it's strategy. We've analyzed more than 200,000 Dubai real estate transactions and found 7 common pitfalls. So today I'm gonna tell you about 7 types of real estate successful investors never buy, and failing ones often do, starting with the properties by underperforming developers. So when a successful investor tries to figure out if the developer is performing well or not, they don't care about developers' promises, they don't care about brokers' intuition, they care about data. And data clearly shows that developers are not created equal. So what we did, we took all the projects that were launched and delivered between 2020 and 2025 and checked their growth during construction. So now we have the list of developers that grew faster than average, that grew slower than average, and that decreased in value during construction. So the list of champions includes Miraz, Nishama, Imtiaz, Iman, Bingari, Imar, Select Group, Ellington, and Maidan. What you've probably noticed that these developers, they're pretty different. Some of them are government-backed, some of them are private, some of them are quite affordable, other ones are luxurious. Imtiaz and Iman are rather small, they delivered just 4 projects since 5 years ago. Bingari at the same time delivered 29. So the size doesn't matter. Take a look at the bottom of the page. Developer that was declining in value delivered 20 projects since 5 years ago. So it's a pretty big developer. This data is crucial, especially if you're looking to resell at handover. But those successful investors who are thinking longer term and think about holding the property for 5, 7 or 10 years, they also consider the growth after handover, when the property is ready. And there is a big difference in how successful investors and failing investors think about growth. Because when a failing investor sees the property by a certain developer that is growing, they see it as a good sign, so they invest. When the successful investor sees the same, they look for comparison points. Let me explain. This chart shows the price per square foot in a residential project by a certain developer on Palm Jumeirah. So since 2020, this developer's project value on the Palm grew by 24%. So it might seem that this developer has done a good job, but then what we do, we compare this growth to the average growth of Palm Jumeirah, and the average ready property on the Palm Jumeirah grew in value by almost 150% over the same period of time. So 24% is not such a great result anymore. So what we do next is we go and check the performance of the same developer in other areas. And it's not that good. Over the same period of time, in another area, their project grew in value by just 12%. Then we check a different area and a different project, and this one declined in value by 7% since 2020. So successful developers don't buy properties by developers that are performing slower than the market. And they also don't buy properties by developers that failed their due diligence. Developers' due diligence is basically a background check, and this is a mandatory assessment of any new off-plan property investment in Dubai. And there are 2 main red flags that indicate that you should avoid investing in this developer. The first red flag is a history of big delays. And it's not like you should look for a developer that has 0 delays. You can find developers like that, but they'll be inexperienced. Any big developer has delays. That's normal. What's not normal is if they're frequent and if they're long. That said, long delivery timelines are not always the red flag. Long timelines could be initially planned. For example, let's take Opus by Omniat. It took them 9 years to build this architectural masterpiece, but it was known from the beginning. They made it clear that the delivery timeline is in 9 years. Also, the developer might be finishing someone else's job. For example, there is a tower in Dubai Marina that was known as Marina 106. It was launched in 2008, during the year of the global downturn. Then the real construction has started just in 2013, and it was stopped completely by 2016. So only a couple of years ago, a new developer bought the project and continued the work. They rebranded it, and now it's known as London Gate in collaboration with Frank Miller. Now let's get to red flag number 2. No history. And the thing is that, in this category, you can find amazing investments, true hidden gems. Some of these developers are great and they're building amazing projects, and they're underpricing them because they're new to the market. But how do you know if it's the developer you can trust? So here's your to-do list. Point number 1, check their completed projects abroad. Because many of those developers, they're claiming that they have a lot of experience in other countries, India, Spain, UK or elsewhere. So what you should do is never taking this at the face value and actually checking everything by yourself. Like the no regret thing, the minimum thing you should do is check the reviews, gather all the information that is available online. But the best thing you could do is go there and check the quality yourself. And that's what we do when we're checking the new developer. We either send someone there or find someone in this location to go check their quality. The second thing you should do is checking their contractors. Because if they're working with contractors that are reputable in the UAE, who have experience working with big reputable developers and successfully delivered projects, then it's a good sign. Also, some of new developers are former contractors themselves, so you can go and check their properties that they built in the UAE. However, be careful with that. There was a case recently when one of the new developers was selling their first project and they were claiming that they were contractors for Ellington and they worked on several buildings for them, one of them on Palm Jumeirah. So those buildings are great. So you might think that this is a great developer, right? So when we checked them, we learned that yes, indeed, they were working for Ellington, but their scope of work was like that. So be careful with those contractors. They could be calling them contractors, even if they were taking garbage out of the construction site. The point number 3 in this checklist is reviewing the top management, because sometimes there are top managers of major developers who are super experienced, the best experts on the market, and they live and create their own companies. So they use the network they built over the years, they take their people with them, and they have decades of real estate experience. And the final step is assessing the project construction costs. Because if the developer is new, you don't know what's their quality, right? So what you can do, you can assess how much money they're investing in the development. And you can compare this number with the other projects in the same class by the developers that are known for their quality. And if they're spending less money on construction than their competitors, then most likely they will underdeliver the quality. I know that developers' assessment is a lot of work, but we can take it out of your plate. My team consists of former management consultants, investment bankers, and Dubai real estate experts with decades of hands-on experience. So if you're looking for help, if you're an investor who's looking to invest in Dubai real estate and get a profitable asset here, drop us a message. For free, my team will do a customer property selection for you based on your goals, and all the properties there will be backed by data and facts. Then we'll help you negotiate the price, negotiate the financial terms, and secure the best available unit. And finally, we'll help you make money on it. We'll resell it or rent it out. So if you want to get a free consultation with us, scan the QR code or click the link in the description. And the next type of property I'm going to tell you about, something successful investors never invest in, are properties in locations with fake growth. It's so misleading. In my opinion, this should be forbidden. It's almost like a scam. And still so many clients were persuaded by agents to invest in certain areas based on this fake growth. Let me explain. So let's take a look at this chart. This is Motor City, and this graph shows the average price per square foot since 2014-2025. And you can see that it's pretty flat. So the price wasn't growing, it wasn't falling for almost 10 years. And then, suddenly, something crazy happened here, and the price per square foot grows by 128% over 2 years. And the area, of course, is proclaimed to be the fastest growing area in the whole entirety of Dubai, which is nonsense. Let me explain why. We should make just one tiny change and take a look at the price growth for ready properties in the same area. And then the picture is drastically different. There is no skyrocketing growth. The average price per square foot in Motor City increased by 24% since 2 years ago, not by 100-something%. The thing is that the area is pretty simple. Basic buildings, no big infrastructural developments, no new big projects, until recently. Then Shoba and some other big reputable developers announced their projects in the area. And of course, the average price in Shoba's building is much higher compared to the average price in Motor City. And this is why you see this crazy growth. Obviously, none of the properties in Motor City appreciated in value by more than 100% over the last couple of years. So you should never base your investment decisions on such fake growth. At least take a look at the ready properties dynamics. It's also not perfect, because after some period of time Shobo will deliver their buildings, they will become ready buildings, and they will drive the ready properties prices up too. So the right thing, the best thing you could do is tracking the performance of residential buildings or residential complexes individually. So you just take the property and track its value, its price per square foot, year by year. But what successful investors also know is that the past performance of the area doesn't predict the future performance of the area. And one of the good examples is Maritime City. If you take a look at the historical performance, it wasn't growing fast. 4% last year, 6% this year, that's not much. But the thing is that Maritime City right now is just one building, and that's it. But in a few years it'll be a completely different area. Now a lot of development is going on there. Beyond, Damag, Danube, Select Group are building their projects there. So it will change a lot, and the future price dynamics, they will not correlate with the past price dynamics. Will be pretty different compared to the past price dynamics. Speaking of prices, another type of property successful investors in Dubai never buy is overpriced projects. And before we dig into that, let's align on what is an overpriced property and what is not an overpriced property. The property is not overpriced just because it's priced higher than average. It's actually a mindset of a failing investor. Unfortunately, the cheapest units or the units with the lowest price per square foot are often not the best investments. Second, just because the property is priced higher than a similar property that was launched 6 months ago, it can be considered overpriced. The market is growing, so unfortunately, we don't have the prices that we had 6 or 3 months ago. Investors should accept the reality, or they'll miss more opportunities. So, the property should be considered overpriced if a better property can be bought for the same money, or the same property can be bought for less money. Let me show you how you can practically use this concept on the example of Dubai Islands. So, there is a project number 1, located over here. It's about 20 minutes from the public beach, and is priced at $814 per square foot. There is another project in a better location. It's closer to the beach, and the price here is $626 per square foot. Given that this developer is delivering a better quality, project number 1 can be considered overpriced. But it's another project nearby, project number 3, and it's priced at $504 per square foot. So, does it mean that project number 2 is overpriced? No, because the concept is better, amenities are better, it's fully furnished, and most importantly, the developer has a better reputation. The developer that's building project number 3 is a newcomer. That's their first project in Dubai. So if you're investing there, you're taking much more risks. By the way, one of the issues investors might face on Dubai Islands is the low level of uniqueness. And the property that is not unique is the next type of property successful investors never buy. Let me give you an example. There is a new project that is launched in Business Bay. Location is not bad, right next to downtown, popular among both expats and tourists. And the developer is pretty good. They're quite reputable, one of those 10 fastest growing developers we discussed in the beginning, but there is one small issue. This building will have 1,000 residential units, and all of them will be pretty much the same, either studios or one beds. And it is an issue, because when the building is delivered, you'll face a severe competition. There'll be 999 other investors who have exactly the same properties as yours. So it will be hard for you to charge a premium. It will be harder for you to find the tenants. So the situation like that creates a perfect environment for the price war. And this is exactly what you want to avoid as an investor. So you go look for an alternative. And there is another project in a master community. The building is much smaller, just 230 units. This sounds much better, right? The issue is that this building is identical to 70 other buildings that are planned in this master community, and the first phase is 50 of them. So actually, your competition will be much worse compared to the first project, because they'll be delivered 11,000 units simultaneously. Unfortunately, it's not a hypothetical example, and we know the results. This project took 6 years to build, and eventually after 6 years of construction, the price on handover was pretty much the same as the price when the project was launched. When the project was launched, the price was around $400 per square foot. When it was delivered on handover, the price was $416 per square foot, which is what, like 4% difference. That's why uniqueness is critical. And there is another type of real estate that successful investors never buy. These are hotel rooms. And it's a bit counterintuitive, right? Because hotels, they should be pretty amazing investments. They should be great short-term rentals. And also, if you want to come and stay in Dubai for a short period of time, that's a great property to live in. Unfortunately, it's not how it works. And this type of property often performs not that great, and you shouldn't mix hotel rooms with hotel-branded apartments. Address Buildings by Emaar, Atlantis the Royal, Omniat in collaboration with Dorchester. All of them showed amazing growth. They might be furnished, designed, might be serviced, might have hotel perks, but they are apartments. We're talking about hotel rooms. So here are 4 reasons why successful investors never buy them. Number 1. Limited personal use. This scenario we just discussed, it's impossible, because many hotels have limitations on the number of days you can stay in your own property, and quite often it's around 14 days. For the rest of the year, the property is managed and rented out by the hotel management. Number 2. You have zero control over operations. You cannot choose who's renting the property. You cannot choose the rental rates. Everything is managed by the hotel management, and they decide the priority of bookings. Number 3. Shared revenue model. Unfortunately, sometimes they use the model when all the revenue generated by all the hotel rooms is shared in certain proportions between all the landlords. So it's not good for you if you've chosen a unit that is better than others and has higher occupancy than others. And finally, reason number 4. High fees. Management fees, service charges, maintenance, cleaning, all of that eat a large portion of your profits. And unfortunately, there is nothing you can do with that, because you can't change the management company. And this brings us to the final type of property that sounds so good, but unfortunately is not what it seems. Guaranteed returns projects. So guaranteed returns are normally 2 things. Number 1 is a guaranteed rental yield. So developers are promising that they will manage and rent out your property and generate around 10% net rental yield for you. Number 2 is a buyback option. So after some time, they guarantee that they will buy your property back. And it smells fishy when I say guaranteed returns, right? So here are 3 reasons why normally nothing is guaranteed. And the reason number 1 is that it doesn't make any sense. Mathematically, the average rental yield in Dubai is around 4 to 5%. Good property can generate more, around 7 or 8% gross rental yield. But some developers are promising 10% net rental yield. So it's 10% plus service charges plus management fees, so it comes closer to around 14%. So how? How would they achieve the rental rate that is 2 times higher than in comparable properties? Now the reason number 2. No legal substance. It doesn't matter what they say, it doesn't matter what they write in brochures. What matters is what they write in legally binding documents. And the agreements that I saw have 2 similar pitfalls. Number 1. Rental yields are not net rental yields. Normally it's stated that 10% is before the fees. And also some sales and purchase agreements explicitly say that buyback clause is optional. And this brings us to the reason number 3. Compensation. Let's say legally is everything clean, and they're really gonna do what they're promising. But how would they finance that? They won't destroy their margins, right? So the trick is that these properties with guaranteed returns are priced higher than alternatives. So what they basically do is that they take money from investors and then give them back to investors in the form of guaranteed returns. These were the properties successful investors never buy. But if you want to learn about real estate they actually invest in, check out the recent video we made. There I told about the best investment opportunities in Dubai real estate right now.